I remember the first dividend stock I bought, Realty Income, ticker O, a very popular REIT. It was about $55 at the time with about a 4.5% dividend yield. A phenomenal stock. I still own it to this day. I'll never forget the first dividends that started rolling into my account. And although it was just a little bit at the time, it was amazing how you could make money by simply holding a stock, not including the price appreciation. So today I'm going to go over 3 very popular high yielding dividend stocks, but these ones are ones you need to watch out for. These are what are considered yield traps. For those who don't know what a yield trap is, maybe you're new to dividend investing or new to investing overall, yield traps are a deadly part of dividend stocks that you must look out for and you need to learn to identify. So we're going to go over 3 really popular ones, and I'll show you some of the signs that you can use yourself to tell if a stock is a yield trap or a great dividend investment. Let's get into it. The first dividend stock we're going to talk about that I've seen all over the internet lately is ticker ACP. This is a credit strategies fund with a nice 17.42% annual dividend yield, a phenomenal yield, but let's talk about why that is really unrealistic to find. This high of a yield is instantly a red flag for me, especially when looking at a stock like this one. First thing I do is I check the price appreciation of the stock. We can see that over the last year they're down 20%, which is not nearly as bad as some other stocks. 5 years down 51%, which is definitely rough. A lot of the market has been in a downtrend for a couple of years, so this actually wouldn't rule it out for me quite yet, but the max chart, which is their all-time price history, down 65, almost 66%. This would immediately rule the stock out for me because they have just been bleeding money this entire time, and it's a red flag. It's one of the biggest red flags you can have as a dividend-paying stock, because all that this means is that the high dividend yield is useless if you're losing value with the price appreciation of the stock, and that dividend yield is going to keep increasing as the price continues to drop because it's a percentage of what is paid out from each share price. So for those that don't know, that's how a dividend yield works. When you see a yield that's 10%, say you buy a stock that's $10 and it has a 10% dividend yield, that means that each year you will be getting 10% of each share that you have. So 10% of $10 would be $1. Now, if it pays out monthly, you're going to be getting 10 cents a month, a little under that, 8 cents a month. And if it pays out quarterly, you'll be getting 25 cents a month. And that would be $1 per year, as long as the price stays the same and you buy before the ex-dividend date. So when you're looking at a stock like this with that continuing price falling, it is a huge red flag. So we'll jump into their dividend history and see their price appreciation has been rough. Go to their dividends. Man, it is just ugly. I'm using Seeking Alpha. You can use this. It's pretty nice. You can see their dividend history as well as a bunch of other things. But we can check here and see that they first started paying dividends when they were on the market in 2013. I believe in 2011 they started paying dividends. They do pay monthly, which is nice. When they first started paying, they were actually paying 13 cents each month. And so that fell to 12 cents as they weren't able to continue to pay out that dividend, and it has continued to fall from 12 cents to 10 cents in 2020. Now you may say, oh, this is still a good dividend yield, paying out 10 cents. Yes, but it will continue to fall following the share price. That's my opinion, not financial advice, but that's what the history has been showing us. So another thing we can look at besides dividend history, we can see their annual dividend growth, payout growth, and their end of the year yield. So we can see that their yield used to be a lot higher and has continued to fall, which is very ugly. Now this is it says 14%, so it is down a little bit in 2021, and you can see that it's paying out less money per share each time, as well as the falling share price, which I don't like to see. Maybe you don't mind, but that's something that's a big deal for me. Now, looking at their fund details, you can see their returns versus S&P 500 over the last 10 years, down terribly. The S&P 500's up 160%. They're down 60%. Now, dividends would counteract that a little bit, but still, it's going to be a really rough time. We can see their forward yield is 17.5%. Negative growth, 0 years of growth because they're not increasing their dividend. They never have. They've only decreased it. And then you can even go down and see more about their competitors, technicals, what they invest in exactly, but still it's pretty scary. Now let's look more at their financials. We can see that their earning per share was a net loss of $2.48 per share, which is extremely a red flag for a dividend paying stock. You want positive earnings per share because that's how they pay the dividend out. Now they do have 1.16 million cash on hand, but $88 million in debt. Their debt history is one thing you can always look at that's important, but still, this is screaming a yield trap. Definitely screaming a yield trap because all of this information is just coming in at the same time. They have 0% held by insiders, a decent amount held by institutions, more than I would have expected. I like institutions to be holding about 30%, especially if it's a consistent dividend paying stock. But still, it's just there's a lot of ugliness to their balance sheet, and these are some of the things that you can really look at that'll show you if a stock is a yield trap. Now let's look at the next one. The second stock on the list, ticker NLY, Annaly Capital Management. This one I may get some hate for. There are a lot of people that really like this stock. It has a 13% dividend yield, which is phenomenal, like I said, but there's a reason for that. We'll jump into the parameters I mentioned earlier. We're going to start with their 1-year chart, their 5-year chart. 1 year down 25%, 5 year down 52.5%, and their max chart down 60% all time. This isn't the ugliest chart, but it is definitely ugly these past couple of years, and that's what I would use. It is nice to see all this old data, but use the last couple of years more for anything. Even with the market being in a downtrend, they were still losing money 2012 all the way to 2018, which was a pretty decent time in the market. Let's go ahead and jump into their financials. So we can see their dividend history has been all over the place, very inconsistent, and they recently just did a dividend cut, which is not good. Dividend cut, not only does it drop the price of the stock quite a bit because investors are scared, but it really, really hurts your overall return, especially if you're, let's say you're retired and you own this stock and you're using the dividends every month to pay for a living, pay for your rent, or maybe you live in a retirement home, who knows, but you're paying for groceries, paying for a car payment. When they cut that dividend, you're all of a sudden getting about 20% less than you would have. So if you were barely making your car payment, now you're not making your car payment anymore. So that is something that's really, really scary when it comes to it, like investing for retirement. For me, I just don't like to see it because I want these stocks to continue to grow. So we can see short interest is low, market cap 10 billion. Let's go down and look at more of their financials. Sometimes they'll have a good financial year, but still be down quite a bit. It just completely depends on how the market treats this stock. Sometimes they'll get a lot of retail attention and then it dies off. So they're actually missing quite a bit of their information here. No payout ratio, 5-year growth, CAGR is down 7%. That's not good. When you're looking at stuff like volume and whatnot, that depends more so on if you're shorting the stock or short-term purchasing the stock. Total market cap is almost 10 billion, total debt 71.2 billion. So their debt is significantly higher than even the worth of the company. They got 500 million on hand and then 1.6 billion in other. Definitely rough. That's another red flag right off the bat. The dividend cut is a red flag. All of this is a red flag. I'm not surprised to see a dividend cut because of their capital structure right now. Trading data, again, doesn't really matter unless you're going to short-term trade the stock. Let's see, percent of shares outstanding. A lot of information about these, not as important in my opinion. Short interest not as important. That's again all for shorting or short-term purchasing of the stock, but definitely some red flags looking through the financial statement. Not something that I'd be looking for. Let's go ahead and jump into the third stock. Our third and final dividend yield trap stock is ticker AGNC. This is actually a stock that I own, believe it or not. As much as I'm having a bash on it, I do own it. Now, that doesn't mean you should own it. I bought this before I really understood what dividend investing was, and it has cost me greatly. Now, I was super excited when I bought this in like 2019, 2020, and I was like 15% yield. I'm gonna make so much money off of this, put in a couple $100, and it has done nothing but fall since then. Even with the dividends being reinvested, which I always do, still dropping. Now it's only down 1% the past 6 months, 20% the past year, and 50% the past 5 years. Now there is a common pattern with a lot of these stocks, as we've seen, the 5-year chart being beaten down so heavily. Now their max chart isn't as bad, only down 51% all time, but still not what you want to see, especially if we look, they have basically been consistently dropping since 2014. 58% down, phenomenally beaten down since that date. And so unless there's some management adjustments or something big changes about a stock, this is not one that I would purchase. Now that I know, again, I did say that I do own this stock, but that is not financial advice. Jumping into their dividends, let's see. They were paying out some really high dividends initially when their price was much higher, and have since then cut and cut and cut. They cut in 2016 2 cents. They cut in 2020 4 cents. And I wouldn't be surprised if we see another cut. It looks like it's on the horizon pretty soon here. It's just ugly. Again, I own this stock. Everybody makes mistakes, and this was one of my bigger mistakes with trading. See, they even have it as a hold or a buy, not in my opinion, but again, that's just my opinion. Let's look more at their finances. Missing some of their data here. Market cap is $6 billion, total debt $50 billion. So a lot of stocks, when you have that much outstanding debt and only that much market cap, it is very scary. Now, I'm sure you guys have heard the phrase more money makes more money, meaning you can purchase real estate and make money that way by having a lot of debt, but making more money in the meantime, which is really complicated. So sometimes debt companies can handle debt that can be really scary, and they can handle it well and make money in the end, become profitable, and work their way out of debt. These stocks obviously have not been doing that. They are beaten down. The dividends have been cut. There's a lot going on. And the first thing that gets cut when a stock is really struggling is the dividend. So while these ones have been paying out, they're not cutting their dividend completely, because their dividends probably what bring a lot of people to the stock. But still, it's definitely very scary. They do have $10 billion of cash on hand. So it's not, I don't think AG&C is as bad, but again, not a stock that I would recommend. Not financial advice. They are down on the 1 year, down 20%. A lot of missing information on here, but you don't even need all that information to see exactly how bad this is. Down almost 8% CAGR, 0 years of growth, and the dividend, we've seen that get cut over and over, even though it pays monthly. Trading data, all that stuff doesn't matter as much if you're buying for a dividend investment, but that's where I'm going to call it, guys. I hope you enjoyed this video, this new style of editing. Let me know down in the comments below. Let me know down below if I made a mistake or missed something, or if you like one of these stocks, tell me why you like it. If you're interested in more stock content, dividend content, finance content, please consider subscribing. It helps me out a bunch, and if you like the video, I appreciate that a lot. So, as always, I hope you guys had a good day in the market today, and I will see you in the next one.